As the real estate market continues to make headlines out there, it's really easy to feel overwhelmed and confused with all the noise that's out there. That's why we're bringing in Acadiana's premier data analyst, Mr. Bill Bacque, back to Real Talk to give us the insights that we need to know about and the state of the market, what's happening, and where his projections are moving forward for 2023 and beyond. Understanding our market data is really crucial when it comes to making any type of decision in real estate. It helps us realtors, it helps our investors, especially builders, and of course you, the buyers and sellers out there. It's a guide to make better informed decisions that can help you save or earn money. So without further ado, here's Mr. Bill Bacque. All right, we're back again. Mr. Bacque, thank you so much for being here for our quarterly review for our market update.
My pleasure.
Super grateful to have you as always, and especially this year where we've had a huge transition into what we're now faced with in the market, which is still low inventory but less demand at the same time. And so there's lots of different pieces here that I really want to unpack, and so let's just jump right into it. So sure. Give us an idea of where you think we are today, an overview from your perspective on the market.
Well, I think the market's kind of in a wait and see mode, if you will. I mean, there's no question that over the last couple of years, we've had a lessening in demand. I mean, from a peak in 2021, from the post-COVID demand. Subsequent to that, we've had two adjustment years downward, and this one is the biggest one. Last year, we did see the market decline relative to the historically record-breaking 2021, but it wasn't quite as significant as it's been so far this year. So our Acadiana total sales so far this year, let's see, and that slide would be page number 9.
Yeah, let's check this. So page number 9. All right. Yeah. So here's last year compared to this year so far.
That is correct.
Yeah.
And one of the things that you can see is that basically from June on, we've seen the market not drastically drop, but just slowly declining. And actually, if you remember back at the end of the half year when we met,
yes,
one of the things that you and I agreed on, that we thought that interest rates were close to their peak at that point.
That's right.
And that we thought in the next quarter, that would have been this past quarter, we had an opportunity to see our sales ultimately, because when you look at June's, well, actually May and June was off a bit, but we thought at that level at some point in this quarter, maybe not say July, but by August we were going to break through, and we'd be on this. We'd be ahead of last year.
That's right.
Well, that didn't happen, obviously, when you see this, and the main reason for that is the substantial amount of increase in interest rates that we've encountered just in this last quarter. As a matter of fact, if you go back a couple of slides to page number 4, one of the things when we talk about interest rates is that the level of interest rates today at, let's say, between 7.5% and 7.75%, that when you look at it from a historical standpoint, that's really not out of line with what the average has been over the last, let's say, 50 years.
Right.
But that takes into account the 80s when you had interest rates at 19%.
Sure.
To get to that. What you can see here is not going back 50 years, but what's just happened in 2022. And you can see it's not so much where the interest rate level is right now, but how far it's risen and how quickly it's risen. And so as you can see here, just in since 2000, we've seen significant, 2020, we've seen significant amounts of increases that have occurred. And where we're just in 2022, the average interest rate was a little over 3%. Now we're in October of 23, it's going up substantially. I think that rapid rise has kind of been a stunner for everybody. And it has put us in a marketplace where today, as you can see, going back to those Acadiana page number 9, our sales over the last 3 months have been relatively stagnant, if anything, drifting slightly downward. And so paying attention to that, one of the things this slide also points out, cumulatively, that demand, our housing market in Acadiana is down a little over 20% this year relative to last year. And remember, there was a decline last year, so we've added another 20% decline off to that, over that. Now, if there's one bright light, and that's outside Lafayette Parish, you can see that down at the bottom of your screen. Outside of Lafayette Parish, the amount of sales are only down 7%. So obviously, if the overall market's down 20% and outside of Lafayette Parish is only down 7%, that means that Lafayette Parish must be faring a bit worse. And
well, and I mean, you know, you could look at that, and I could tell you, you know, what's happening is, you know, as interest rates are rising, the lower price range homes are becoming more desirable, and the average price outside of Lafayette Parish is just, was it like $50,000 less than inside of the parish, which is what's driving that demand on the outside of Lafayette Parish.
You're absolutely right.
Yeah, because what's happening at the same time, although the demand and the interest rates are higher, you know, the prices aren't going down, because we're in this interesting market where we've got, you know, new listings are down 17%, you know, from last year, and that's 18% below where pre-COVID. So we've never seen, I mean, you'd have to go back, I don't know, you would know this, but it's got to be over a decade since we've had this few of listings hitting the market in a year to date like this year.
Actually, I do have that, and if I remember correctly, the new listings are down to 2012 levels.
And I have the active listing count in Lafayette Parish is actually up from last year, 22%, but it's down 71% compared to pre-COVID averages.
Absolutely.
And so, you know, that's what people don't, you know, although we were selling and we had a super high demand during COVID, during 2020, 21, 20, and the beginning of 2022, we had a lot of demand, but we also were fulfilling that demand with a ton of new listings. So it was demand driven, and our prices were going up, and we were listing more houses than we ever had at that time.
Right.
Whereas now the demand is low, but the new listings coming onto the market are so few that, you know, it's still outpacing the supply.
And the reason for that is primarily because of interest rates. Right. Not the interest rates that are keeping buyers from buying. It's the interest rates that the sellers have already acquired over the last 3 to 5 years.
Have you ever seen anything like this?
This has never occurred in my 50 years in the real estate business. Typically, we follow the basic tenets of supply and demand pretty well. That is, if there is a drop in demand, you generally are going to see an increase in supply. Okay, and vice versa.
Which will drive the price down, which we're not seeing. Yeah.
Demand goes up, inventory goes down because it can't keep pace with demand. Right. Okay, but in this situation, we've had demand drop and we've had inventory drop, or at least stay the same as far as new listings coming on the market dropping. overall inventory is creeping a little bit up only because there's nothing being sold. But
that same rate of the inventory going up, we're losing in new inventory coming onto the market, which is keeping those prices where they're at.
And you know, when you look at the data, approximately 75% of all homeowners in the United States either bought a home in the last 5 years or refinanced their home in the last 5 years. And so these 75% of those existing homeowners, which would be sellers in a market exchange, they're sitting on interest rates that are typically below 3% or below 3.5%. And when you have 7.5% to 7.75% interest rates currently, they're looking at that and saying, even if I have equity that I have that I've been able to accrue over my home ownership, I cannot replicate. My current indebtedness is going to be significantly higher, and that's going to eat up all of my equity. So therefore, I'm not going to put my house on the market. I'm for, if you will, lack of a better term, I'm trapped in the house that I'm in because of my interest rate.
Which you predicted a year and a half ago when we met. You did. We did have this same conversation, and we didn't know where we were going from there. But I think, I mean, I remember us having this conversation, like what's going to happen when interest rates increase. You know, when these homeowners are trapped in their house,
right?
And we're seeing it now.
Typically, what would happen in a marketplace where you would have inventory that is not moving, you would see price declines that would offset somewhat that interest rate environment. What we've seen here, again, that's unique, is although there has been some slight adjustment downward in values, those have been relatively minor because of the lack of inventory. And as a result of that, we have basically, the average sales price and the median sales price is not declining enough to make a seller say, well, gee, I know interest rates are a little bit higher, but prices are down. I still want to make an upward move. I could see that. Okay. Yeah. We don't have that. We don't have that environment. And that's the thing that's unique to this marketplace now. It got so out of kilter because it was a manipulated marketplace. It's been manipulated by the Federal Reserve going back actually to 2008. So we've been now in an environment for over a decade where interest rates were nominally low. And then when we got into the COVID years and Fed went into overdrive, then we got into interest rates being historically low, and now we're seeing them coming back to where they, on average, have been for the last 50 years, and people are freaking out, and justifiably so. It's not because of the level of the interest rate, it's because of the level of the rise in interest rate as quickly as it did.
You know, it's interesting because, you know, we're seeing, you know, through our funnel, you know, the buyers are still coming in. I mean, we still have first-time home buyers, you know, people moving from apartments to wanting to make that jump into the house. And you don't have that big of a objection. I mean, it is what it is. If you just had if you're in an apartment and you got married and you just had another baby, you're moving one way or the other. Right. And so the interest rates isn't really affecting the demand as much as it is the listings coming onto the market.
Right.
And but we're still, you know, we call it the 3 Ds, you know, the diapers, divorce, and death. That is all still happening. So we have to, there's got to be some pent up supply there that at some point it's going to release, and it might not release until that interest rate starts trending downward.
Right.
But at some point, you know, it's like, you know, people know now, the people we're discussing this with that are like, hey, I'm buying a house. I want to get into the game. I want a piece of that American dream. They understand, well, you know, just like what you had said, you know, now it's about, you know, marry the house and date the rate, where, but in COVID, it was marry the rate and date the house.
Right.
Now people all just understand, well, we could buy it now, and then when interest rates adjust, we'll refinance in 2 or 3 years. But the biggest challenge that we're faced with out there in the field is really we just don't have enough supply coming onto the market to fulfill the demand that we have. So, I know we are using it at our team. We're literally door knocking. We're going to house. We're getting back to some of the basics that we used to do, which is we're mailing, hey, I have a buyer for your neighborhood. I just don't have a house.
Right.
If you're thinking about selling, let's do it. And we're getting creative with different things that we can do to offer to the seller, make it easy for them. However, the seller is also, when they're coming into the market and they're making that jump, they're also being very reasonable because they see, the demand has changed and they are a little, it's a little bit more of a challenge.
And one way of showing that too is if we look at, again, our Acadiana home sales and the cumulative is down 22%.
Yeah, so this is...
excuse me, we're down 20%. If you go to the next...
And Lafayette Parish is 28%.
Right, but we go to the next slide, and that's the dollar volume, okay?
Right.
Dollar volume of Acadiana. So total sales down 20%, okay? Dollar volume's down 22.1%. So that shows you that what people are buying is slightly less expensive than it was before.
Sure.
Not by a lot, okay?
Yeah.
And outside Lafayette Parish, again, down 6.8%, while the sales are up 6.9%. So again, not quite as impactful outside of Lafayette Parish. Now, if we go to page 16, we see Lafayette. Lafayette cumulative.
Lafayette Parish. Yeah.
Lafayette Parish, cumulative sales are down 27.6%, 28%. When you break that out, you'll see that existing home sales are down actually almost 30%, 29.7%, and new construction is down 21.2. So one of the things that we are seeing happening to a slight degree is the fact that existing home sales are strained is giving some impetus to new construction to kind of fill in as best they can that shortage. So yeah, you are seeing, and as a result of the lack of inventory in existing homes, you are seeing that there is that demand that's still out there is impacting on new construction sales to where they're not being impacted as much as existing sales are.
But the builders are not stupid, and they're seeing what's happening. And I can tell you that there's more reluctance about starting new projects, which I foresee a shortage in new construction. In the spring of next year, if that continues and interest rates do drop a little bit, we're going to still have that supply issue, which means prices could still increase.
A couple of things, though, some builders are doing ultimately to kind of armor themselves. Many cases they have moved outside of Lafayette Parish. Mm-hmm. We're seeing an uptick in new construction outside of Lafayette Parish because the typical differential between an average sales price for new construction in Lafayette versus an average sales price outside of Lafayette Parish ranges anywhere from $50,000 to $60,000 differential. That's impactful for a potential buyer, especially buying new, because those set the upper limits. New construction sets the upper limits on pricing of everything. But going back to Lafayette Parish, we see a 27%, almost 28% decline in dollar volume. But when we look at in sales, but when we look at dollar volume for Lafayette Parish on page 18, you can see that the overall dollar volume is down 27.7. 27.7. Sales are down 27.6. So when you look at that on its surface, on the surface, you would say, well, gee, that's not much at all. There's not much. They're about equal. But then when you break it out, you'll see that the dollar volume on existing homes is down 32%, while the dollar volume on new construction is down only 16%.
Which is telling you that's because there's just not the supply in existing homes out there.
Exactly.
That's exactly what's going on. But I do want to point out, volume is, I've averaged out, but, sales are down around 27%. And volume is down around 28% for Lafayette Parish. But when you compare it to pre-COVID, which you've said multiple times in our past shows that, at some point we're going to go back to where we were, where it's, I hate to say normal, but at some point the COVID artificial market is going to end and we're going to go back. And looks like we're getting close to that. I mean, sold, if you go to like the average pre-COVID going back to, 2012, we're only 6% below total sales if you factor in 2012 to 2019. But volume, we're up 21%, which is what we saw with that average price increasing over the last 3 years significantly. And if you average that out, in Lafayette Parish, our average sales price is around $285, I believe, give or take.
Right.
$285.
Next slide. Deals with that.
Which is interesting because, we're significantly higher than we were pre-COVID. And if you were to average out the last, couple of decades or 2 or 3 decades, we typically see around just under 3% increase. So if you took 2019 to where we are today and we had that normal appreciation, our average price should be around 255, 258. So we still have that the value of the houses are staying up even with the demand down, but it's because of the supply.
Right. But again, one of the things you have to be careful about is when you look at the overall average sales price and the overall median sales price, that is a combination of both existing home sales and new blended together. So I think what's much more important is looking at the breakdown between, and this is in Lafayette Parish. Yes, the average sales price is $285, almost $286,000. But the average sales price for an existing home is $269,000. And it was last year $279,000. So actually existing homes are down 3.6% or almost 4%. Okay?
Yeah.
It is new construction sales that are up 6.9% from 308 to 330,000. That's the reason why you only have a 0.2% decline in your average sales price. It is because of that new construction, even though it's a smaller percentage of the overall, it is impacting sales prices. So if I'm an existing seller, potential seller, I got to look at what's happening to existing homes, both in the average sales price, where you've got a 3.6% decline, and a median sales price, where you've got a 2.1% decline.
Which, I think this is such an interesting topic and conversation right now because, it's so dynamic. I would argue, being out in the field and working with my team members, that the reason why, we're having trouble with, in the existing home sales is strictly because there's just not enough homes for sale. Like I know for a fact we've got people looking for every price range out there for existing homes in the core of Lafayette that just do not exist. I mean, we're still dealing with multiple offers. I mean, we're going above list price for houses in certain areas in certain towns, not across the board. So it's, it used to be black and white. Okay, we have this much supply, we have this much demand. This is what you should expect. It's really interesting because, you could be in the same neighborhood and you could have an oversupply of one price range and an undersupply in a price range that's above that price range, which is unusual.
Right.
Like we do not have in, G2 or West Bayou area or this core area, there's not enough houses in the $800,000 price range, to go around. Like, of course, it doesn't mean you can overprice it. There's just no inventory. So if there were inventory, if the people would put their house up for sale, I would argue we probably would, that existing home sales price would be higher. It's just they're not there.
Yeah. Yeah.
It's really interesting because usually we see, when you look at the market and you're looking at the different price ranges, you usually see, the higher you go, the more supply there is and the lower, the demand. But it's kind of intermittent.
Well, and again, that's part of the function of a low amount of existing inventory. That is, if I'm shopping in virtually any price range, I've seen everything that's on the market.
Yep.
In that price range. I mean, and so now what I'm waiting on is incremental demand, incremental supply, a property coming on the market. And so it's not surprising that when you get an attractive listing that is well priced, that you're going to get the most eyes looking at it right at that moment, because the people who are out there looking have already seen everything else.
Right.
And so if you're going to get a feeding frenzy on any kind of property, it's more likely going to be one that just comes on the market because it's fresh inventory.
Yeah.
Now, you were talking about the comparisons to other years, and in part of my presentation here, beginning on page 41, where we look at what those market trends look like in comparison to other years. And so the first one is looking at, again, all parishes, all Acadiana. You can see that through September, we've had 4,001 sales. If you want to find a year that is comparable to that, you'd have to drop down to 2018. And you mentioned, previous meetings that we had, we talked about prognosticating is very difficult to do. But I thought that we would probably end this year back to 2018 pre-COVID level as far as transactions. And that's proving to be relatively accurate as far as the transactions are concerned. Next slide, though, is what you pointed out. The dollar volume of those transactions, just a little below $1 billion. The closest level to that would be, it's above 2020, which was 938. So where we're going to go back to 2018, it looks like we are just below 2021 as far as the dollar volume is, 2021.
Which will make it probably the third
best
year ever in volume.
Right.
And yet we're 28% below in sales.
Right. Now, the next slide is Lafayette, and you can see the cumulative sales there. And if you look down here to go to 2368, you'd have to go to actually about 2016. Okay. Then when we get to the next page, our dollar volume, again, close to 2020.
Right.
A little bit below. So it's kind of proving what we said.
Yeah.
Now, another interesting slide relative to new inventory. Let me find that because I found that was quite interesting. No. Where do we need to go for that? Yeah, that's actually page 6. This is the new listings. Acadiana new listings. 5414 new listings. Go down here, try to find a year with closest to that, 2014.
Which is better than Lafayette Parish.
Yeah, I didn't do Lafayette Parish.
Yeah.
But that's it. The inventory, we're down to 2012 levels. We're at 2018 demand levels. We're at 2021 dollar volume levels. It's all over the place.
Yeah.
Okay.
Yeah, and exactly what you just said. That's what's keeping the prices. We just don't have enough inventory. Which at some point you've got to. There's got to be some type of release in the inventory in the future. Just is it going to happen, sooner than later, or is it going to be over the next 4 years?
Well, what we want, I think the ideal thing from the standpoint of a homeowner would be, let's have it over a longer period of time, because if there is adjustments in the market, either upward or downward, they tend to be smaller if it's dragged out in small increments. What we don't want to see, and it's because it's generally associated with the overall economy, is something to happen. We go into some deep recession nationally or something like that happens, and then we start seeing unemployment, people losing their jobs, don't have income. It doesn't matter what your interest rate is if you don't have a job and you can't pay your note. And then we'd see an unusually heavy amount of inventory that would come on the market. That's not what we want to see.
Right. Or you want to see if the interest rates do dip, you want that demand to increase at the same rate that the supply is increasing, or right. In our case right now, we need more supply.
I do think that if we do get into an interest rate environment that is declining, it is not going to be one where we get back to 3% levels. Okay, that hopefully that is all gone in the past, and I say hopefully because what brought us to that was intervention by the Federal Reserve and the federal government pumping money into the economy. If we get into a serious recession, that could happen again, okay? But if it happens again, then we're creating another false economy that ultimately we'll have to pay for at some point in time down the road.
Yeah. Now, so what do you think? I mean, from a seller standpoint, you may be a seller soon. I mean, you're in a big house right now, and eventually one day you're going to probably downsize.
Right.
For the baby boomers out there that are, in a similar situation, what kind of advice would you give to somebody that, like my parents, do they?
Well, one of the fortunate things for many baby boomers, if they are like me in any way, shape, or form, I don't have a mortgage on my house. I've lived in my house long enough, paid it off. So the impact of lower interest rates or even higher interest rates are not as great on someone who has no mortgage whatsoever. And I would presume that if I sold my house, I'm not at 73 years old, I'm not looking to go out and acquire more debt. Although I think that's the height of optimism. If I would go out and get a 30-year loan at 73, that says something. Maybe that is a smart move. But typically you don't do that. So I'm a cash buyer. The market doesn't, interest rates don't impact me, but prices do. Okay.
Right.
But if I'm able to get a higher price or this level price for my property and I'm moving within that same market, at least I would have a lateral move as far as pricing. I might buy a more expensive or less expensive, smaller house, but relatively speaking, I'm in that same market at that same time. So hopefully things will equate.
Well, and it sure does look like we're at the peak of the prices.
Yeah, the interesting thing into the future, Jim, is what is housing going to look like 25 years from now, okay? When all the baby boomers are gone. And we lived in that period of time generationally where the thing that was popular was what they called McMansions. Little mini mansions. You had the river ranchers and all of that type of stuff that we bought these these extravagant houses. We did, relatively speaking. Newer homeowners coming up into the future, I'm not sure that the model that we used through the 50s, 60s, 70s, 80s, 90s, going into the 2000s is going to be the same model that necessarily is going to work for affordable housing into the future. I mean, we already know that there is a significant differential between what the cost of new housing is and existing homes. And so redeveloping a new model is going to be a long-term thing. But I see the future where we're going to have to look at how people are going to be living in a more communal type of ownership aspect. So I could see more of these subdivisions where you have amenities, HOAs with amenities that are shared by everybody, smaller living areas. We may even have a cluster houses where outdoor entertaining areas and all of that are all shared by homeowners to keep prices down. I don't really, your imagination is the only thing that limits you as to looking at what future housing could be. A lot of other areas of the country where commercial properties are seeing post-COVID are being tested for occupancy and things like that in urban areas that may be transitions into residential use for what were formerly commercial areas. I mean, think in terms of the Acadiana Mall, which is old architecture,
Right.
old
Yeah.
style shopping, doesn't fit in today's marketplace. What do you do with something like that? Could it be readapted into some kind of affordable housing? It could if you have creativity and you're not stuck in your own prejudices about what a house could be. That is, we have too much of this not in my backyard syndrome going on. We're going to have to think differently, I believe, into the future and creatively when we look at what housing is going to be. Because quite frankly, if you go back 20 years, the average sales price was probably about $150,000. Today, it's $260,000. I would argue you can't have that increasing amount of value in that unit continuing at that rate ad infinitum. There's going to have to be some change in how we view housing stock relative to the prosperity and the income and the earning capability of future generations.
Well, I mean, haven't we seen that? Like, we've seen.
You're doing something with, what is it, the builder group right off of Congress Street. And on Johnson.
Yeah, on Congress, yeah.
Yeah, where you're taking
Infill,
a lot,
right.
infilling it,
Yeah.
and making it high density, where it was originally a lot that was meant for one house, and now we're going to put three. That's the kind of thinking that has to happen.
Sure.
But you got to be worried about the neighbors coming in and saying, well, I don't want three houses there.
We deal with it every day.
Every day.
Yeah.
And we're going to have to be more open as a society to looking at models that are more adaptable to the needs than they are to staying where what I got is what I got, and anybody else, if you want something, you got to have what I got. Okay, we can't have that kind of thinking.
Well, going back to I'm going to reframe this. Do you think that we're at the peak of prices? Is this, if you're a seller, is this the time to put your house up for sale?
I think that if I were going to look out 3 to 5 years, this is probably a good time.
This is probably, and we talked before we started this podcast, like, it looks like we're going to be going into something similar that we saw between 14 and 17.
Right.
3 years of almost a stagnant price increase, or it all depends on the release of the supply.
And there are there are other factors that are going to impact maybe not as great as supply and interest rate, but one that we certainly are encountering now is the insurance problem. Is the not only some properties, depending on where you're located, more south of Lafayette Parish, where even finding insurance is maybe challenging, but the cost across the board is going up dramatically, and that's adding to ultimately the cost of what's going on. Also, where we're seeing just incremental drops in sales prices, 3%. Okay, that might be something going into the future, but not dramatic declines. And one thing that is
Right now, we're less than 1%.
less than 1%.
Yeah, like I think it's 0.2%.
Now, here's the interesting
So
thing.
basically, we're right where we were last year to date, as far as average sales prices.
Here's the interesting thing. Next year is a reassessment year, statewide, 2024. And so all the benefit that we saw in the rapid rise of prices from 2019 through 2020, really 2022, all of that is going to be bundled up into the assessor's valuing of your properties next year. So if you're a homeowner, I would expect your assessed value to likely rise next year, no matter what is happening in the market. Okay, the market we may still have declining sales prices, but they're going to be basing it on this past year's values next year.
Which brings up a good point. If you are a baby boomer, you really need to freeze your taxes. Go to your tax assessor and
if you're over 65,
you're over 65, freeze them so that it's not going to go up more.
Absolutely.
But honestly, I could see the prices go either way. I mean, if we start to see a decline at some point, which most experts believe by this time next year we could be less. Now they could be wrong. I mean, it's like playing craps. But assuming that all of the experts, we do see a downward turn on the interest rates, and we see an increase in the demand, and yet the sellers are still reluctant to put their houses on the market, we could see prices continue to increase, and it could even go higher if we do not see more new listings coming on the market.
I agree with that.
So it's really, at this point, it could go either way as far as pricing.
It could.
Yeah.
It could ultimately. One other thing too, and a lot of it has to do with Fed policy, economic policy, and there's plenty of room for criticism on both sides of how they've reacted over the last decade or so. But one of the things that we look to the Fed for too often is just interest rates. What are they doing with interest rates? But another thing that's impacting on real estate interest rates is they're backing out of acquiring mortgage-backed securities. So it wasn't just setting the benchmark rate for lenders or banks that have impacted interest rates. It's also during the COVID post-COVID arena, actually going back to 2008. The Federal Reserve has been buying up mortgage-backed securities, intervening in the mortgage market, buying up those interest rate securities, and by being a player, buying them up, that creates a scenario where when high demand for interest rate securities, the securities are sold at a lower rate. So their intervention into the securities market helped to keep especially long-term rates for real estate at lower levels. The estimates are that they're not intervening anymore, and there's roughly about $30 million a month of mortgage-backed securities that are maturing that the Federal Reserve is just letting fall off the books. Okay? That is, they're not replacing it by buying mortgage-backed securities. Economic prognosticators said that if the Fed would just keep, when they get that $30 million drop, reinvest in the securities, that could impact the rate on 30-year mortgages up to 1 to 1.25%. So we could actually have interest rates decline if the Fed wanted to prime the pump just in real estate and would reinstate, not going aggressively and buying, just replacing what we're pulling off their balance sheet each month with new
Okay, so
that could happen.
That makes a lot of sense, because I've been wondering, they base typically over the last 30 years, the 30-year fixed mortgage rate has been on average 1.7% above the 10-year Treasury, and yet now we're at like 3%. And
right.
That's a piece I didn't realize. That's probably why the margin is so higher. Like to support what you're saying, even if the interest rates on the 10-year Treasury went up, we could still go back down to below 6% if it was averaging out the way it was the last 30 years.
Right.
So that's why I didn't realize that. I didn't have that piece of information.
And the Fed has at this point chosen a tight money scenario across the board. But if in fact it sees this is all tied, the Federal Reserve actions now are primarily focused to try to get inflation under control. If in fact, and all the indicators are showing that the rate of inflation is slowing down. Inflation's not slowing down. The rate of inflation is dropping. And if that continues and the Fed is satisfied there, but they're seeing that the real estate industry is taking it on the chin totally to a degree that the rest of the economy is not, they could intervene that way and still keep relatively high the benchmark interest rates, and still give some relief to the real estate industry. Is that going to happen? Who the heck knows?
Well, I mean, that brings me to another question. We're moving into the fourth quarter of 2023. Next year, we're already starting to prepare for the elections. You hear a lot of talk or chatter about, well, in election year, things are going to change. And I mean, what do you think about how the election is going to affect? You've been through, at least 25 of them.
Well, that'd be 100. No, I'm not quite.
15.
2-year cycles. Yeah, sure. That's the $64 million question, is what's the Fed going to do in an election year? If you look at what they do, their general tendency is to not be political. And so in election years, those are the years, even when they're trying to make some kind of aggressive policy statement, it tends to be milder during election years, because they don't want to make what they're doing an election issue.
Sure.
So I would expect some potential for softening next year, or at least stepping back and let's see what's happening. There's a lot of reason for doing that, irregardless of whether there's an election. A lot of people who are economic pundits are saying what the Fed has done to tighten interest rates has been to ramp it up extremely quickly. And we've seen that in the graph that we saw, and that is causing chaos, and that maybe they need to stand back and at least say, hey, we're not going to, we're through for the moment till we see what's happening. And that seems to be what the messages are that we're getting at this point, that next month we're not going to see an interest rate hike. Because the Fed is seeing that rates are actually been going up, bond rates, and are actually been going up without them raising the interest rate this last time. And I think maybe they're going to sit back on the sideline and see what happens. But that doesn't mean they'll become aggressive toward intervening on mortgage-backed securities. I think their policy is going to remain the same. They're shedding it, and I'm just saying that's one way they could impact the housing industry without impacting the other areas of the economy that they're trying to tampen down.
The challenge is, though, as you know, like every house we sell, that turns into $50,000-$60,000 shot into the economy with everything else. So like it's their favorite lever to pull,
right?
Because not only is it affecting the real estate industry, but every time we sell a house, I mean, when they want to improve the economy, they pull that lever and reduce it. The interest rate. It's not just the housing, the sales that we're dealing with. It's everything that goes along with moving. I mean, I think the average is like $50,000 in other expenditures where, that consumer is going to go out and spend money on other services, furniture, everything.
Right.
And so it doesn't surprise me that they are pulling back, and that's what they're trying to do, is not just, they're not worried about the home sales or the prices as much as the whole economy, which you and I had that conversation. What's the right thing to do? Do you take it, do you rip it off like a Band-Aid and shoot it up and hopefully come back to normal faster? Or do you, have a more painful long-term?
Well, there's consequences either way.
Yeah.
Again, I do recall back in the 80s that there was a conscious decision that was made by local lenders, because local lenders had the majority of stock, housing stock, through foreclosures. And they were faced with exactly that dilemma.
Yeah.
That we've got all these assets on the book. We need to liquidate them, but if we liquidate them all at one time, it's going to crash the market.
Right.
But do we want to not do that and just let the inventory out in little bits? But their decision was, if we did that, we're going to just prolong death by paper cuts. As opposed to, let's just slit the vein, get it over with, and then we will rebuild. And that's what they did. And true to form, we saw average sales price drop over a 2 or 3 year period by about 50%. Yeah, it was devastating. But that began then. Once we got rid of all that inventory, there was a slow buildup, and we went through the 90s, the 2000s, and all the way up. And this is basically, with some little irregularities, but we basically have been on an upward swing to where we are today. And there's been an adjustment in the marketplace over the last couple of years, and maybe it's going to be stagnant for a few years, but I do believe ultimately that trend will start back up again. Typically a 3% over time appreciation rate annually is about what housing has done over the last 50 years.
Yeah. Well, you brought up foreclosures because, I get in conversations all the time, are we going to see more foreclosures? And, at this time, what do you think about that before I give you my opinion?
Where we're different this year than, let's say, in 2008, when we went through the last recession, where there wasn't a significant amount of of foreclosure here in Lafayette Parish, because the overall economy wasn't impacted as bad as it was in other areas, although it was impacted here. So ultimately, I do believe that we're not going to see a significant amount of foreclosures happening here today. And the reason for that goes back to what's creating the imbalance of new inventory coming in. You got people who are sitting on houses where they've got interest rates that are 3% or less, okay? And they've got equity that was built up over the last 3 years. So they're in a situation that's totally different from where we were in the 1980s. We've got people with equity that they can ride out a significant storm of housing dilemma that I don't see really actually happening, but they have that capability to do that. So whereas in the 2008, where people were using their house ATM teller and refinancing up to maximum amounts, but not getting any appreciation, then the moment that there was a hiccup in the economy, the first thing they walked away from was their house because they were in negative equity. We'd have to have a really devastating economic event for the equity that's built up over the last few years. Matter of fact,
Well, yeah, I mean, you're looking
go
at
to page number, what is that? Page number must be 5. Okay, just looking here. Okay, the average sales price for a home located in Lafayette Parish increased $62,000 from 2018 to 2023. That's an increase of 27.6% in 5 years.
Yep.
And in this last year, it's declined by 0.2%.
Right.
The median sales price, you take the average aside because the average you can always say, well, those $3 million houses in River Ranch and all that. Take that out of the picture. The median sales price takes away the highs and the lows. The median sales price in Lafayette Parish has increased $51,000 in the last 5 years, 26%. So where we are as a housing ownership group in Lafayette is totally different from where we were in 2008, 2009 when we went through the last deep recession.
Yeah, and for that to happen, we would have to have a huge influx of inventory.
Yes.
For foreclosures, because then that would create the sales price to be below where it is.
Right.
And even, right now it's just not even on the radar. We have so little inventory coming in the market, which is creating the foreclosure problem. Also, you're going to see, and we have seen an increase in foreclosures, but it's minimum. And when you go from no foreclosures, because during COVID you couldn't foreclose on a house, to an increase of a dozen homes, that could be seen as 100% increase. But it's still just, there's not many foreclosures opportunities out there because there's so much demand. And if you want to sell your house, you can sell it and typically get out of it without losing anything.
Nobody wants to go through a foreclosure,
right?
Because it typically, that puts a stain on your credit. You can't go out and buy again. So the people who go through foreclosure are typically forced into that through their financial situation that they're in. And my only point here is, if I'm sitting on $50,000 to $60,000 worth of equity, and I'm getting potentially foreclosed
sure.
on, okay, I can go out into the marketplace and price my house $25,000 less than it's worth, $30,000, and walk away with money. Okay.
Yep.
That's the difference that we have today versus high leverage refinancing that was done back in the early 2000s, and without the growth in the values.
The price. Yeah. So foreclosure is just not a huge.
It's not going to be enough. Not going to be enough to impact the market negatively.
Right. And let's talk about pendings, because that's one thing. Although we don't really, it's really a crapshoot what's going to happen with supply and demand based on the interest rates. What are we looking at for the next 90 days?
Well, let's see. If we turn to page 36. That's the pendings. Well, as of October the 10th, 6 days ago, you can see that we were right about where we were last year in October, in September, as far as all pendings. But these are adjusted down through fall throughs. And I could easily see last month, you can see the 508 versus 491. Last month, before it's been adjusted down, we were actually above the 508.
Right.
Okay? So fall throughs took us below that.
Yeah.
Here, I would anticipate that over the next 30 days, the fall throughs will lengthen the disparity between last September and this September. But that still being said, I'm hopeful that you can see that September, October, and November of last year were not really great months. Typically, we get into fall, you're not going to get in, it's our seasonal low anyway. But my hope is that we'll get crossover potentially in October or November.
Sure.
And hopefully that'll happen. It should, because we're not. What happened last year at the end of the year was rate hikes.
Right.
And we're hopeful that that's not what we're going to be seeing at the end of this year, next quarter. We're hoping that the Fed is going to pause on that and that we're going to see some stability as far as rates. If rates go above 8% in this next quarter, all bets are off.
Yep. And so, I mean, it does look like, based on the data, that we should see a crossover in sales versus last year.
Right.
I mean, right now we're, year to date 28%, but towards the end of the year, October, November, it should be at least very similar to last year or a little bit better.
Right.
At the end of the year for the fourth quarter.
Right.
Year to date, we're going to be below where we were in volume in sales, but our volume is still going to be higher than we were pre-COVID.
Next slide is the dollar volume of those pending sales, and that's even more optimistic because you can see the crossover did occur, and it was fairly significant from 111 million pending last year adjusted to the 118.7 million, which is unadjusted, but I would suspect that it won't go below that year. So that will be the first month in 2023, I'm predicting, where the pending sales dollar volume will exceed the any month or exceed the previous year. Let's put it that way.
So looking at all of this data from a builder's perspective, what would you tell a builder, if you had a crystal ball, what would you tell somebody that is, their job is to continue to build and find properties to build on? What would you be looking at?
Well, what I'd probably show them is the data that reveals the amount of increase in building outside of the parish of Lafayette. And I would say, depending upon the price points that you're building in, but if you're going to build in, let's say, the 290 to 350 range, you may want to be looking outside of the parish of Lafayette. Simply for the ability to, even if your price points are the same as in Lafayette, what you can put into your product is substantially more simply based on the cost factor. And so one thing I would say is look at what's happening in Iberia Parish, look at what's happening in Vermilion Parish, look what's happening in St. Landry Parish, look what's happening in St. Martin Parish, look what's happening in Keaty Parish. All areas where there have been substantial new construction that's been initiated over the last 2 to 3 years. And if you flip even in Lafayette Parish, if you flip to the next page, page number 38, I think it is, that's pendings in Lafayette. Lafayette Parish pending sale. You can see that the 270, the September number, even before adjustments, it was below. But move over to the side and see September pending, the second paragraph, September pending sales of existing homes were down 24% in September from last September, but pending sales for newly constructed homes in September were up 90% for the month than last September. So what does that show? That shows that the demand in September was significant for new construction. That is an anomaly, though. It's not, don't
Sure.
think that's going to continue on, but it does show the strength of what that muted demand that we are experiencing is not in any way, shape, or form rejecting new construction. As the the existing inventory of existing homes remains on the market longer and becomes more stale, then buyers are going to matriculate over to new construction or be tempted to, and the actual numbers seem to bear that out.
Yeah, so I mean, when you're building a new house, you're 6 to 8 months out. If it's a 500,000 plus house, so like, I mean, it's just so hard as to look at this data and come up with any conclusion about what the supply is going to look like that far out. But I do know that that's what the challenge the builders have, and the risk that they have in front of them is, how do I, decide on, how many houses do I start? How many houses do I want to have ready, and where do I want to have them ready? Because you could also look at, okay, well, there's more supply outside of Lafayette, and maybe the way to go would try to find a lot interior because there's no supply.
Right. Well, I will agree with being a builder is a tough occupation to be in.
Yes.
Because you got to go out and justify you're building a certain amount of product is your forte. You got to convince your lender to fund it, and then and you can have all the data in the world that's existing. What you don't know is how many builders there are out there at that particular moment that are planning to do the same exact thing you're going to do. And so inventory is so slippery for a builder because you don't know when you start building something, it isn't going to come out as inventory in 4 months, till 3 or 4 months down the road, sometimes 6 months down the road. And you don't know, maybe there's 50 other builders who are saying the same thing, even looking at data and saying, gee, there's not an awful lot of properties, new construction in this price point. I'm going to build there based on what's the data is right now. And you're right, solid, spot on. But what you don't know is, again, there's 20 other builders who are looking at the same data, and they're deciding at the same time, I'm going to build the same thing. And so when they start bricks and sticks on the ground, now suddenly you've got a lot more product than you had bargained for.
That's
or
right.
even predicted. So it's really tough. But that's all you have to go on. And I think maybe one of the things we can look at there is what's the existing inventory look like? And so if you look at page 31, we will look at what we call the overall number of months supply of product. Now, actually, going back one more slide, this is just educational.
Yeah.
Number of months supply of product is based upon the demand that is currently available for housing that we're experiencing and the existing number of homes. Based on this kind of demand, how long would it take to exhaust this amount of listings in this inventory? And if you see the little graphic there, typically, if you have a 5 to 6 month supply of existing homes relative to demand, that's what we call equilibrium. It's about a balanced demand and supply, so that there's not an abnormal amount of pressure upward or downward on prices. The more you get over an abundance of inventory, more properties on the market than there is demand, then you have increasing supply, more product, less demand. And the more you go away from that 5 to 6 months upward is an indication of whether or not you should see values declining or not. Conversely, when you have a low amount of inventory, 3, 4 months or 1 to 2 months, that puts pressure on housing values to stay high or relatively high. So 5 to 6 months is equilibrium. And where are we?
3.3.
3.3 months in Lafayette Parish overall. Now that's up from last year, We were at 2 months last year, but still well below equilibrium. So now what we do is take a look at it in various price points. So if you go to the next page, you have under 150,000. Now, granted, there's not a lot, certainly not a lot of new construction. There's no new construction available at under 150,000. So these are all existing homes. But you can see, based on the demand, if you're under 150,000, while the overall is 3.3 months, there's only 1.4 months supply of product. 321 sales, only 50 listings available.
Right.
1.4 months. Last year, that was 9/10 of 1 month. So it's gone up. And then you go into various price points, and you can see we have anywhere from 9/10 of a month supply or 8/10 of a month supply to 19,000 and under. There's an 18-month supply. Now, 18-month supply, you might, wow, what is that? Well, when you look at the numbers, there's been one sale in 9 months, and there's 2 listings on the market.
Right.
That's 18 months.
Yeah.
It doesn't really mean anything.
Yeah.
The bulk of where we get our sales is the next page, and that's 150,000 to just under 299,000. That's where as 56% of all, we're on page 33.
There we go.
That's where 56% of all our sales are. Now, here we have a 2.9 month supply of product overall. Again, below the 5 to 6 months, which would be equilibrium. And then you can look here at the various price points in here, all of them except one in that 260 to 279.9, where you have a 5-month supply. Everything is under 3 months or less. And then we get to the 300,000 and up, the upper end, if you will. And here you've got about 31% of our market in this price point. It is, you've had 728 sales, 386 listings. Here you have 4.8 months. This one is close to equilibrium, 4.8, 5 to 6 months. Last year, it was 3.6 months. So there's been a significant amount of buildup of supply in this price point. And you can see here, for the first time in Lafayette Parish, different price points that are above 5 to 6 months. Okay. This is the tricky area.
What's interesting is, this is it's really a inventory supply issue, not where it's increasing. The months of inventory is increasing in this price range, not because we have more demand, but because we're putting less on the market.
That's correct.
And there's less demand. So we have less on the market, where if we had the same amount of demand, this would be a lot lower. It would be at three months, but because we don't have this new inventory hitting the market. That's a...
Think about if we were at the same demand that we were in 2021 at this point. There'd be nothing on the market. Yeah. There'd be nothing on the market. But perhaps then we would have more new listings coming on the market.
Because the prices.
Because of the prices.
Yeah.
So again, if I'm a builder looking in these price points, or even a seller, you kind of... you have to be a little bit more cautious in the number of months supply of product. Now, the interesting thing, you can see $1 million or over, okay? Here we've had this challenging interest rate environment, real estate market, blah, 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 blah. There have been 26 sales so far this year over $1 million in Lafayette Parish. This is phenomenal. Now, there are 32 active properties, or at least there were on September the 30th. So you have an 11-month supply there. It's a bit crowded.
Sure.
But really, going back in time, that upper end has always been a crowded field.
Sure. Yeah. I mean, we've seen it. We've seen it at 28 months of inventory before.
Yeah.
I've never seen Lafayette get below 2 months of inventory until 2 years ago. We've never even come close to that. But this is really a great overall, it's something that as a seller or as a builder, you've got to be looking at, but you got to dive deeper into even the area. You've really got to know, okay, what is that environment like in that neighborhood or in that geographical location, which, that can change drastically, less than a mile.
That is the reason, and that's above my pay grade. I'm one of the, my job is to look at the market from, let's say, 2,000 feet of that length and look down. But you're absolutely on point, Jim, and that is where having a schooled real estate professional advising you on that altitude below 2,000 feet going to the curb is crucial, not only for a builder who's looking at it potentially, what do I need to put down on the ground as far as inventory, but it's also important for both buyers and sellers of existing properties.
All right, well, we blasted through our time as usual, but give me an overview summary of what do you think about this market after everything we've talked about? What should we see over the next 90 days?
Well, a couple of things. My admiration for people who are in the business that you're in has gone up dramatically because just 2 years ago, all you had to do was have a real estate license and you had money in the bank. Okay, now's where the rubber meets the road. These are the times where you earn your money, and I have all the respect in the world for people who are chosen this industry and are professional at what they do. That being said, I am very grateful that I spent my career in real estate and it's over. I'm happy to be retired because these are challenging times. And there is that old Chinese curse that we are cursed when we live in interesting times. These are extremely interesting times. One of the things, though, I would say is real estate has always been a long-term investment, a long-term a product or asset. So I think if we look at things in only a short-term perspective, we can lose sight of what the overall benefits are of owning real estate and being involved in putting people into homes where they can raise families and be contributing citizens to the community. I think it's a wonderful and fulfilling occupation and endeavor, and I tip my hat to those of you guys who have the courage and the stamina to continue in it.
Well, that didn't tell us too much, but I appreciate you saying that. I think, we are
That's
seeing...
another way of saying God bless you.
I think it's a mindset as well, being in the industry, there's lots of opportunities. There's no shortage of opportunities. And if you're, this, the people who own the most amount of real estate here today in Lafayette or in Louisiana, they bought it in the 80s, when there was opportunity. So, I think it's a great time because we have opportunities, but we also have some challenges, as always. And, when we had super high demand, we had low inventory,
right.
So I think from a real estate standpoint and other agents, it's more of a mindset. You can either allow the circumstances that are out of your control dictate what you're going to do, or you can be proactive and go out there and still make it. We're still selling houses. This will still be, one of the top 6 years in the history of Lafayette. So if you think that there's not opportunities out there, I think you're mistaken. And from a selling standpoint, if you're a seller, this is not bad news. You're in a good place. And from a buyer, what's interesting is, we have sellers that are willing to work with us. Right. They see the environment. You know what I mean? It's one of those times where, and this, usually you have where the demand is super high and the sellers are non-negotiable and they're just stuck in their ways, or it's vice versa. This is an interesting thing. You know, we're going into listing appointments where, you know, sharing this information and sharing the data is allowing us, you know, the sellers know that they have to do what they need to do to get it done, where, you know, sometimes there's a lag, you know, and in this case, we're in a good place as far as, you know, if you price your property right and you manage the other variables involved with it, you can sell at the top of the market today.
Right.
And if you're a buyer, you can still get a good deal, but you have to be proactive. You got to be looking at everything that's out there, all the different sources, off-market properties, for sale by owners. You know, one thing that we've been looking at is expired houses. Houses that expired in 2018 and 19 when we were in a different market.
Right.
Calling those sellers up and saying, hey, things have changed. We've got a 26% increase in your equity, and we've got a list of buyers that are willing to buy it, you know, at your terms.
Right.
So, you know, I appreciate it. And you know, I think we're always going to have that, you know, we're always going to have those challenges. And, you know, but I mean, this information is invaluable. Like it's so important to know what's going on in the market. And I can't thank you enough for being here today to go over this.
And you know, I just want to reinforce what you just said. You know, there are three basic necessities that everybody needs: food, clothing, shelter. Okay, and the three basic necessities of mankind, and you're involved in one of those three. That's some heady stuff. I mean, you know, you can pick a lot of careers to be involved in, but there's nothing like putting together a young couple with a home for the first time and seeing what that does for them, and then ultimately following them through the maturity of their years, and when they buy their second home, and buy their third home, and ultimately retire
and get into the investment game
and get into the investment game. So, you know, hats off. You're right. It's challenging, but we've always faced challenges of different types, and we've overcome them. And, you know, again, one thing you can always be assured of is that you are involved in an industry where people have to have what you have available for them.
And it's the fastest way to create generational wealth. There, you know, it's really a good place to be. But with that, I do want to hear from everybody out there. Like, if you have any questions for Mr. Bacque, we will, you know, follow up with them and get them answered. And then if you have any comments or you think we got it totally wrong, I want to hear about it. Please leave your comments and reach out to us. Let us know. And I'm hoping next year, you know, for the year in review, you'll be right back here.
You know, it's hard to get away from the numbers. My decision to ultimately retire was not my decision. It was I'm going to blame my wife for it. It was my wife's decision. She wants me to spend more time with her.
Bring her here. We don't mind. She can come sit here at the table with us.
She'd be a better guest. So anyway, yeah, I don't know if I can get completely away from the numbers. I like them too much.
Well, you're always welcome here, and I just thank you again for everything that you've contributed to our entire industry here in Acadiana. So thank you.
Amen.